When I tell people I lost $100,000, the first thing they ask me is, was it the stock market, was it cryptocurrency, or a bad business decision? Well, let me tell you guys, it wasn't any of those. What happened to me is something far more common, and it caught me completely off guard. And in today's video, I want to take you through how I lost a small fortune, the red flags I personally missed, and if you're ever in my situation, you can hopefully avoid my same fate. Before I tell you exactly how I lost $100,000, let me take you back to where it all began and why I thought this was going to be the best financial decision of my life. Back in 2011, I started my first real job. I was working at a video game startup that made Facebook games in the Bay Area here in California. And my job was pretty simple. I made around $40,000 a year to answer customer support tickets. The company was called Kabam, and famously, it actually bought the rights to name the UC Berkeley Cal football team's field at one point for $18 million. I heard about this particular job through a childhood friend of mine. Her name is Steph, and she had joined the company before it even rebranded to the name Kabam. So she was an early employee, and she was telling me how great it was to work there and how she was awarded a bunch of stock options and equity. Now, when I joined, the customer support job did not offer stock options or equity, but I still worked there in hopes of getting equity one day. I kind of knew at a rudimentary level, like if I were able to get stock options, that could be the key to true wealth. I personally have had friends retire early because they hit it big at different startups, and these days you even see these polls on Twitter that showcase that the average NVIDIA employee, for example, has over $1 million in net worth. Well, fast forward to working in that job for about a year, and even though I'd been promised promotions for good performance, which may have one day included equity, plain and simple, that just never happened. So that's lesson number one. Corporations will sometimes tell you what you want to hear and also dangle a carrot in front of you to get you satisfied with your current position. It's always going to be unclear whether or not they actually mean what they say. Now, I did end up leaving that job, and then I actually did foray into the finance part of my life. So that's when I became a financial advisor, and I also became an intern at an investment bank. Now, one thing I did realize is after working these financial jobs is that I was still dreaming of that big payday. Now, the part of the story where I lose the $100,000 happened when I took actually my next job after the finance stuff. And for those of you that have been waiting to hear how I lost it, I will just quickly summarize that it was due to something called underwater equity. But how did that happen, and what does that term even mean? Well, this job was at a YC-backed company called Machine Zone, and YC, for those of you guys that don't know, stands for Y Combinator, and it's the startup incubator that's very elite, based here in Silicon Valley. It's responsible for alumni companies such as Airbnb, Dropbox, Coinbase, Stripe, and Reddit, just to name a few. Basically, it's a really popular startup program where if a company successfully gets accepted and goes through it, you're usually a startup that is most likely primed for a ton of success. I mean, just look at some of the valuations of the companies here I just listed. So Airbnb, $80 billion, Dropbox, $8 billion, Reddit, $27 billion, and Coinbase is over $70 billion at the time of this recording. So I kind of knew that by joining Machine Zone, if I were able to secure some sort of equity package in the company, that could be pretty big. And that's the entire reason people go and work at tech companies that are pre-IPO in the Valley. They want to hit a unicorn and they want to be able to make a bunch of money from the exit. So Machine Zone was a video game company, much like the one I previously worked at, that had a huge focus on mobile game titles such as Game of War and Mobile Strike. If you remember, or maybe you don't remember, these were the same games that had advertising during the Super Bowl with celebrities like Kate Upton and Arnold Schwarzenegger.
Do you want to come and play?
Send a dozen choppers when one chopper would do. Build walls twice as high as you need.
So those were some of the commercials, and at the time I was working there as a monetization analyst, assisting with increasing revenue for the games on a real-time basis. In short, all that really meant was that whenever you log into the game or whenever you log into a mobile app, you get shown a sale, and I was the person making those sales. We had a lot of real-time data on what types of sales perform the best, so if you understood video games and economics to some degree, you could create sequences of sales that not only improved revenue hour over hour, but also kept the game's economy in balance. In some ways, creating sales is somewhat analogous to creating YouTube videos. There was sales art, which is the thumbnail of the YouTube video these days. And then the actual stuff that I put in the sale, that's like the YouTube video itself. I do like to think that that job gave me some sort of training that provided me some relevant skills for the YouTube career that I have today. Anyways, in the time that I worked at Machine Zone, we grew from 100 employees when I started to over 1,000 in just 2 years. And the company continued to raise money at aggressive valuations. In fact, in 2014, it was valued at least at $3 billion, and at one point, Machine Zone was valued at over $5 billion in 2016. To this day, Machine Zone still ranks 16th in the top 100 YC companies by funding, only behind Reddit, Gusto, and GitLab. So that hopefully gives you some sense of how bullish the tech world was on this company and how bullish I was on this company. So when I was given the opportunity to buy stock options of this particular company, I love the idea. But here's the thing, Machine Zone did not use what are called RSUs or restricted stock units. They used a different equity compensation model that were just called stock options. I'll throw up a table right here of the key differences of RSUs versus stock options, but what you need to know for the purpose of my story is that while RSUs usually represent the actual shares of a stock of a company, stock options give you the right, but not the obligation, to buy a specific number of shares of the company's stock at a predetermined price within a certain time frame. That's a mouthful, but basically all you gotta know is RSUs are as good as shares, but stock options simply give you the option to buy shares from the company if you wish. And stock options can give you a lot more upside potential because the price you are offered for those stock options can be way less than what the stock actually trades for. So imagine you worked at Nvidia before it went public and you had stock options with an exercise price of 25 cents per share. And let's say you're working at Nvidia and they go public and all of a sudden the stock starts trading at, say, $1 per share. Well, if you're working there, you can exercise your options. You can essentially buy shares of Nvidia at your price of 25 cents per share. That's known as the exercise price or the strike price. And then you can take that share and sell it on the open market for $1 a share, thus netting you a hefty profit. That's a specific scenario in which a company actually goes public and you can make the difference between your exercise price, what's given to you, and the market price. But if you're at a private company that has not gone public yet, you are given stock options with exercise prices, and since the company is private, you have nowhere to really sell the shares. So if you ever want to buy the stock, you can, but there's no point to because you'd have nowhere to sell them after. They're just kind of represented by a piece of paper and that's it. There's not much value to a private company's stock until there's something called a liquidation event, such as a share buyback that the company offers you, or your company goes public and then you can sell your shares on the open market. Sometimes there are private dealers that want to buy your shares on the secondary market, but that's slightly different, requires a lot more hoops to jump through, and oftentimes they don't pay you nearly what you think they are actually worth. So the stock options of a private company are a gamble, and as long as you work there, you always have the option to buy them. Now, where it does get tough is if you quit your job. And that's exactly what happened to me. In November of 2016, I was burnt out on the job, often working late hours and weekends, and I just wanted to try my hand at something entrepreneurial while I was still in my 20s. So when I quit Machine Zone, I found out that you have 3 months from your last day to exercise those stock options. If you wait any longer, you actually forfeit the right to those options and you no longer have the right to buy them anymore. And this presented a problem. The strike price of my options were around $5 per share, and I had the option to buy upwards of 22,500 shares. If I bought the full amount, that means I'd have to write a check for 22,500 shares times $5 per share. That's over $100,000. It was about 112K. That's a huge gamble for a stock that's not even public. But again, you have to remember at the time, Machine Zone was just valued at $5 billion. Their growth trajectory was like crazy. And in my head at the time, Machine Zone was definitely going to go public. They had even hired some key people that specialize in the IPO process. So when it came to what I had to do with these options, I even asked my dad, and he asked me, well, do you think the company is going to go bankrupt? To which I replied, no. Then he asked me, do you think if the company goes down in value, it'll still be worth something? And I said, well, yeah, it should still be worth something. So he kept it simple and said, well, yeah, it seems like a pretty good bet then. So buy the shares. What's the worst that could happen? So I bought them. I bought about 19,791 shares at a $5 strike price for a grand total of $98,955. And let me tell you guys, that was, not the greatest decision. I will tell you the worst case scenario because in hindsight, the worst case scenario actually happened. And later I found out that this was actually a very common scenario among many private companies. So after I bought the shares and after I left the company, I heard that the original CEO actually got replaced by the board of directors in 2018, so about a year later. That was a shame because I believe that he was the main brains behind why the company did so well in the first place. So without him at the head of the ship, I thought they were a little bit doomed. In 2018, it was reported that MZ had raised around $720 million in a new round of funding, which this is a key part of the story, so please pay attention. That means they've raised over probably about $1 billion to this point. So 2 years goes by, and then it was reported that Machine Zone was probably going to get acquired by AppLovin, which is a public company on the stock market. So after hearing this news, I was pretty excited. I was like, okay, they're gonna get acquired by a different company. Maybe my stock options are worth something. So I emailed the stock provider at the time, but unfortunately the email I got back just said something along the lines of sit tight and wait for updates. Well, I did get further updates a little bit later, and unfortunately all the documents they sent me, it just came down to the following. Quote, because the merger consideration was insufficient to pay the aggregate liquidation preference of the company preferred stock, approximately X million, at the effective time, all shares of company capital stock other than shares of participating stock, other than dissenting shares, were canceled and extinguished. What that means is all the common shareholders, aka the employees who bought the stock and perhaps outside investors who owned common shares, they got wiped out, as in all of their equity was worthless. And that's because Machine Zone got acquired for $500 million, which sounds like a big number until you realize they raised $1 billion. So the investors invested $1 billion, but they only got $500 million at most back. And the reason I lost all my money just comes down to liquidation preferences. So in startups and even in real estate, they have something called preferred versus common. So preferred shareholders versus common shareholders. Preferred shareholders have a higher priority on the company's assets in the event of a sale, liquidation, or merger. This means that before any money is distributed to common shareholders, the preferred shareholders are entitled to receive their liquidation preference, which is a predetermined amount often equal to their original investment plus any accrued dividends. In this case, the preferred shareholders had a liquidation preference of approximately X million. I can't really say how much. And since the merger consideration was insufficient to cover the entire amount that they invested, all the value that was in the merger was used to satisfy the claims of the preferred shareholders, leaving nothing for the common shareholders. So there you have it. The biggest risk an employee has at a startup is that common shareholders are usually at the bottom of the payout hierarchy. If the company doesn't perform well enough to create value above the preferred shareholders' claims, common shareholders will bear the majority of losses. This structure is basically designed to protect early investors like VCs, for example, who take on significant risk by providing capital, but oftentimes they aren't the people that are actually building the company. So I want to leave you guys with 3 things that you can take away from my story. Number 1, if you work at a company that offers stock, understand the key components of the company before buying the stock. That includes number 1, knowing how many shares are outstanding. This can tell you what % of your equity is worth of the company. And number 2, what the liquidation preferences are of your stock if it were to come down to it. Bullet point 2, evaluate whether or not your company is actually on track for an exit or if they're just selling you a story in order to keep you there. You can look at comparables in your industry. Have they gone public? And if so, what are the multiples on that revenue typically? If you work for a transparent company that tells you how the company is doing in terms of revenue, you can usually ballpark what the exit could be worth. And bullet point number 3, consider asking for a higher salary or bonus instead of equity if the risk seems too high for you. Also, if you're considering working for a company and in the interview process, you can ask if they offer RSUs or stock options. That would be good to know. And you can also ask what the last valuation of the company was. It's a normal question to ask, and you can also ask how much they've raised and what the runway looks like. In any case, accepting equity-based compensation is always going to be a risk, but if you find a stellar company with a great growth potential, you could make a lot of money very quickly. So this was my cautionary tale of how I lost $100,000. I'd love to hear your stories in the comments, or if you don't want to put them in the comments, you can drop me a line on Twitter. I post daily there, as well as Instagram. That's another great place to reach me. Lastly, if you feel bad about me losing 100K back in the day, fear not. At least I have this selfie with Arnold Schwarzenegger that I can fall asleep to. All right, thanks for being here. See you in the next one. Get to the chopper.